You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi there. Welcome back to Talking Real Money. I'm Don McDonald, along with Tom Cock. And, we're always here to help. We come around every weekend, Saturdays on Como Radio in Seattle, to help you better understand money. We also do a podcast that airs at least 5 times a week. And that's at TalkingRealMoney.com or on your favorite podcast service. And you have a standing invitation to call us with your questions at 855-935-TALK. That's 855-935-8255. Of course, the time you can call us live and we can actually have a conversation Saturday afternoons between 3 and 5 Eastern or noon to 2 Pacific. If you're in Seattle, it's noon to 2 Pacific. 855-935-8255. So before you do something you might later regret or try to straighten out a mess you already have, call 855-935-TALK. Like, for example, if you're thinking, I'm going to go buy me some GameStop at $370 a share, or I'm just like Tom, I'm going to buy some AMC, or I'm going to become a stock market timer, or you need to think again. You really do. I mean, there's a lot. It's not just because we don't think it makes sense. There's a lot of research that shows it doesn't make sense.
Well, there was always a lot of research that showed that moving in and out of stocks lowered returns.
Well, yeah,
right? Because you miss some of the big days in the market, right? That's an easy, and we could go through all the numbers. We're not going to, but there's now a new study out that finds that active trading also increases the volatility of the portfolio. And which makes sense when you think about it, right? Because you're buying and selling stuff. I mean, and we've already seen the numbers from last March where people sold out of stocks and then they're still waiting to get back in. But some new research by Dr. Ilya Daichev of Emory and Chin Zheng of the University of British Columbia found that 50%, it's amazing, the volatility of actual investor experience 50% higher than the corresponding volatility of stock returns. In other words, if you just bought and held and you did nothing, you didn't move the money around versus moving the money around, how much bouncing around. So here's the way I look at this, Don. People feel better. I'm moving out of that because it went down. I'm putting it in cash or bonds, and then I'm going to buy that when it goes up. You feel better about all that, but it actually not only lowers a return, it increases the ups and downs of your portfolio. It's a bit counterintuitive, but it's just another reason, frankly, that market timing
strikes me as one of those things, that the more you're moving money, the more volatile money's going to be.
Yeah.
That
makes sense.
I call these, it's like value stocks tend to outperform growth stocks, or small company stocks have tended, past tense, to outperform large company stocks. These are called duh factors, at least in my vocabulary, because, it's limited. Of course, undervalued assets have a better potential. Of course, littler companies have more room to grow. And of course, the more you move your money between things, the more volatility you're going to incur. And we believe volatility is there are just really 2 kinds of major risk: volatility and permanent loss.
And huge. By the way, they also looked into Robinhood, some of the investors there, which Robinhood claims our guys are buy and hold people. I don't believe you for a moment. But the most popular stocks on Robinhood, here's their study on that. They tend to decline after they've been the most popular between 5 and 9%. Let me say that again. After they've been the big ones, the big movers on Robinhood, they tend to decline. And this is not a surprise because they get pumped up. And I think you could clearly say that right now with a couple of issues that have been pretty pumped up here lately by the boards and by everything else. And then people lose interest and they go down and they sell out because I made a lot of money. I read about the kid who got $100 worth of I think it was GameStop, and just sold it for $3,500. I mean, that's the kind of thing you hear about, and that's the kind of thing that you really need to avoid in your portfolio, period.
And the other thing there, Tom, is it's not just the volatility, because when you're trading in and out of individual securities, you've got that risk of the big swings in value, but you've also got that risk that you could get into a company like AMC was nearly bankrupt.
It was teetering.
They were right
truly
on the brink. If they didn't get that emergency infusion of venture capital, really,
$970 million.
If they didn't get that, they were on the brink of filing for bankruptcy, and they didn't have there really wasn't a lot to allow them to restructure. It could very well have been a full liquidation bankruptcy. But even in a restructure bankruptcy, this is what people forget. It's like they think, you talk about Delta Airlines that went bankrupt, and they go, well, I own Delta stock. No. The people who owned it before the restructuring, they lost everything. They lose it all.
GM, Enron, WorldCom. It happens. Individual firms do go bust.
So your risk is huge. It's not just one thing. It's everything. It's magnified when you move your money, is what they're saying. We'll be back. 855-935-TALK.
Tom and Don are talking real money.
Retire Meet has gone both national and virtual. Join Tom and me along with a host of other retirement experts at Retire Meet America 2021. Reserve your place now at retiremeet.com, retiremeet.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK is our phone number to talk about money. And that number works 24 hours a day, 7 days a week. And I want to warn you of something. When we get full with calls, this happened last week, when we have all the lines full, if you call that number, you will be routed to the voicemail. And so if you want
this is Don. Call me back later.
If you want to be on the show, then you'd have to call back in a bit. Otherwise, if you call and leave your question there, we'll answer it on a podcast next week. Okay? Just want to explain that.
I'd hear my suggestion, the shorter version, call back in a couple minutes.
Or call back.
How about that? Yeah.
Like Bob did. Hi, Bob. Welcome to Talking Real Money.
Thanks for your persistent.
Hey, Bob. Yeah. What's up?
I called back. No big deal. Hey, I'm trying to come up with a income-paying portfolio for my RMDs that I have to take on another 2 years from now on exchange-traded funds. I have 6 funds. Let's see, the annual expense ratio, according to Morningstar.com, is of the 6 would be 0.32%, and they say an expense ratio of a similarly weighted hypothetical portfolio would be 0.42%. Okay.
What do you want? What do you need us to help you with?
He wants an income portfolio. So, are you? Yeah.
Well, I got. Do you want to know the 6 exchange rate?
Sure. Tell us the funds. Tell us the funds.
Okay, they're iShares. Let's see, iShares. What was that? Well, it's an emerging markets bond fund.
Okay.
High yield bond fund.
I know. Okay, go ahead. What else? You got 5 others.
A preferred stock and foreign large value.
Foreign large value?
Yeah.
Okay. And what else?
Oh,
that's 3.
Okay, you got the emerging markets, you got the high yield,
you got a high yield.
Yeah.
Foreign large value, preferred.
2 large values, 1 preferred, and the foreign large value.
Oh, okay. So you've got the large value are growth funds. Are equity funds. Equity funds.
Right.
And then you are being absolutely crazed about stretching for yield, aren't you?
Well, I guess, yeah. It says I can get 4.21% with this portfolio. If I have
but how much can you lose? How much can you lose? How much can you lose?
Oh, I don't know.
A lot.
Yeah.
Oh my gosh!
RMDs.
Well, okay. Let's go back.
All right.
Let's go back.
Tom.
I mean, first of all, high yield. Even the best of the high yield, the fund that if you're going to use high yield, the Vanguard Corporate high yield in 2008 lost a quarter of its value, 25%. We do not recommend bond funds that can lose that kind of money. Emerging markets bonds, which probably are helping that yield too at like 5% as a guess. Those are in countries that if things get ugly, and they always could for whatever reason, you're looking at a high default rate there as well. So you could lose a lot of money. This is a very important lesson, I think, for every investor. First of all, there is no shortcut to getting high yield with no risk. Number two, the bond should be the ballast part of your portfolio. Number three, if you really want to get a dividend payout, you just own the market and take what it pays you every year. You don't go after the high dividend paying stocks because that limits your diversification in the portfolio as well. So I don't like this strategy at all, Bob, to be honest with you.
Bob, this is first, it's way too complicated. Second, you are looking at the yield number, and that is probably the most dangerous thing to do for someone who wants to generate an income from their portfolio. In this environment, a high yield is really, really risky because what looks like a reasonable yield to you is actually a truly, truly out there yield. So what Tom says is the way we believe this should be done, and we believe it fervently. You need to create a portfolio that has both equity, well diversified, not just value, that is U.S. and international, that is built to take into account your risk profile, your need for return, and your ability to accept volatility. And then you withdraw. Let's say you need 4% per year. You own this huge portfolio with thousands of stocks and tens of thousands of bonds in it. You draw from that portfolio 4% per year. You don't worry about what the income stream is. We have been trained for too long to think like banking, that you got to just get an income stream from your portfolio. And that's not the way it has to work. As a matter of fact, that's not even the best way to work going forward. The past shows us pretty clearly that you can take 4% per year out of a well-balanced portfolio and not worry as much and not take as much truly intrinsic risk, lose it all kind of risk as you're taking with this portfolio. 855-935-TALK is our number. 855-935-8255. Carolyn, you're next. Welcome to Talking Real Money.
Hi. I have an IRA, and some of it is in Roth, and most of it is not. And I was thinking maybe that would be a good way to start transferring some of it into the Roth so I can not get killed if I want to make a large purchase. Do I need more specific?
Oh, you mean so then use the money later to buy some, take it out of the Roth and avoid the big tax bill that you would in the traditional IRA? Is that what I'm hearing?
Yeah.
Are you what kind of income do you have right now? What kind of tax situation do you have?
A very low one, like the 10%.
You're in a very low bracket. Okay, good.
Yeah.
Then what you ought to do is you need to do this with a tax plan. You take out enough money that you don't kick yourself up to another bracket, so that you're paying more dollars on your dollars you're taking out. You want to stay in the lowest bracket possible. And you take it out, you transfer it over to the Roth, you just recharacterize it as a Roth, and then from that point on it grows tax-free, and you're not subject to required minimum distributions.
Well, now I'm going to make one more suggestion. Here's the painful part of all this. I would never, ever, ever pay the tax out of the IRA for that relocation to Roth. And I see a mistake of this regularly. You got to have the cash to pay the taxes before you make that move.
Why do you say that? Just out of curiosity. Not that I was going to do it, but I'm just curious about.
Because what you're doing is you're sucking down some of that money that is going to grow tax-free for you. Because you can't put any more in a Roth. Roths are a finite resource, and you don't want to take any of the money that can sit there and grow for years tax-free out to pay taxes. You want to use money on which you've already paid taxes to pay those taxes.
Okay.
Because
I was thinking of maybe transferring like $10,000 or $15,000.
Okay. So that'll probably cost
that wouldn't be a big
that'll probably
impact,
cost you $1,000, $1,500 in taxes. Worst case scenario, if you're in a low bracket, if you have that in another account somewhere, then I believe you're in good stead. I would suggest you consider doing that. Thanks so much for the call. 855-935-TALK is our phone number, 855-935-8255. We're talking about your life. We're talking about your money, and we really, really want to help you build the best possible future. Don't go away. 855-935-8255.
Tom and Don are talking real money.
Learn about estate planning, Medicare, Social Security, senior housing, investing for retirement, generating income in retirement, and protecting yourself from consumer scams, along with a special keynote duo, Paul Merriman and David Booth, the founder of Dimensional Fund Advisors. Reserve your free place now at retiremeet.com, retiremeet.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Call now. You were waiting for a line to get open? Call right now. 855-935-TALK. Right now. Before somebody else does it. 855-935-8255, because there is one open. Bill, you're on. Welcome to Talking Real Money.
Hey, could you tell me why the stock market went down Wednesday and Friday?
I think I could safely say there were more sellers.
Are you going to say
buyers.
more sellers than buyers? I knew he was going to
Yes.
do that. I knew he was going to.
I'm pretty confident in that answer, Bill. I'm very confident in that.
Actually, let me give you a better answer than his smart alecky answer.
Oh, okay. Oh, I see. You want the speculative answer because
No.
I'm
I'm
not
not going to give him.
Let me
I'm not
explain
going to
my
give him the
reason.
speculative answer either.
Well, no, because let me explain why what you're going to say is speculative. I
No,
believe
it's
there are
not. You
somewhere
don't know what I'm
around
gonna say.
60.
What do you think? You know what I'm going to say?
60. I do. 60
do
million
not.
trades a day. To know why people sold and why people bought, you would have to go interview all of them. Then you would have to collate that information to come up with, well, this guy said it was because GameStop. This guy said,
You have no idea what I was
going
going to say. You have no idea.
Go ahead.
You have no clue what I was going to say. I was going to say because the market does at times go down. It has to at times go down. And we will never know in advance why it went down, nor know in hindsight why it went down. We just can't know those things. Now, let me tell you what you will find is you will find thousands of people on CNBC, on Fox Business, in the Wall Street Journal, in Barron's, at MarketWatch, all of these places. You will find thousands, tens of thousands of people who know what you want to hear, and they're going to tell you what you want to hear because it's called pandering. They're pandering to everybody out there who asks that question. Why did the stock go down? Because the next question typically is, what's going to happen
do
from here?
Yep.
And I can tell you on Monday,
well,
and I'll give you another smart aleck answer. Ready? It'll go up or down.
There you go. No, it might go sideways.
Well, it could go flat. No, but usually it's up or down. Rarely do we get a 0, 0, 0 across the board with all the major indexes.
These sound like smart aleck answers.
Yours
but
did.
The reality is, that is the correct answer.
That's the correct answer, yeah.
It sounds like I'm being a you-know-what, but I'm not. I'm just telling you this is what we know. This is what everybody knows. But as you just said, there's this multi-trillion-dollar industry built on the fact that people have somehow put themselves out there, and you're supposed to believe them, and they don't know. Sorry.
Then you will get. Here's some of the answers you might get if you ask this of others. Things like, well, the market was trading at a ridiculously high price earnings multiple, and it was due for a pullback. And traders were believing that the Fed might raise interest rates or something. They're going to give you 1,001 different stories. Well, we're worried about COVID, whatever it might be. But the fact of the matter is, we do not have a single solitary clue, and we never will. And if anybody gives you a different answer than that, this is an absolute fact. If anyone gives you a different answer than Tom's smart alecky answer or my slightly more impassioned answer, they're lying to you. Please understand that when we're talking billions and billions and billions and billions of dollars at play every single day, there is incredible incentive to say things you want to hear, not that you need to hear. And this is an absolute fact about the markets. You cannot know in advance what they're going to do. Please, every single one of you listening to this show, get that through your heads. You cannot know it. It is literally impossible. And any of you who believe that the future is accurately and consistently predictable, I'm not going to be a smart aleck, I'm going to be hard on you, is totally deluded.
All right, Mr. Khrushchev, quit pounding on the table.
I don't have my shoe on. I did get my shoe, though.
Because the question then always is, so what do I do? Well, here's what you do. You mentioned the risk quiz earlier. You take the risk quiz.
Yep.
Number 2, you know what return you're trying to make on the money, the purpose of that money. Number 3, you accept the volatility that's going to be associated with the return you're trying to make. And then
stop being greedy.
You take up chess. No, you take up chess, you do something else. Because you're not watching this, it does not matter. You find another game that is interesting and will not reduce how much money you have, because watching the market, guaranteed, will mean less money for you and your heirs into the future.
I would suggest, though, if you're looking for a game, don't become a soccer referee. Don't do
Oh,
that.
come on. I'll be back on the field next week.
Oh, I know. It's a scary
Toting the
thought.
whistle and 3 masks. So we'll see how
I
it
want
goes.
you to get on that treadmill and run for 90 minutes with a mask,
the mask on.
Yeah,
It's
I
not
want to
gonna
see
be
how
pretty.
you do. And make sure you wear your Apple Watch so when you fall, the paramedics will know where to come to. Thank you so much.
And Don are talking real money.
Now everyone can meet the retirement of their dreams at Retire Meet America 2021 online. Sign up now for free at retiremeet.com. That's retiremeet.com.
Reality radio for a really great future. We're talking real money.
The sooner you get over the mistaken belief that there is some expert out there, there's somebody out there who knows the future and you don't, and if you just find the right expert, you're going to get rich, the sooner you will become a real investor. You'll stop worrying about money all the time. You'll stop worrying about your portfolio. You'll build what you need to build and realize that you can patiently wait it out. Your expectations need to be lower. Always. Be happy with the return of the market. Quit trying to beat it. Be it. 855.
By the way, yeah, go ahead. Give the number.
855-935-TALK.
Yeah.
Yeah. Okay.
Once you do that,
Yeah.
here's the other good news. You don't have to listen to us anymore.
Right.
Sorry, it's over. You can find something else on Netflix. Goodbye. Sorry, I shouldn't say that, but it's true.
Some people actually like listening for the grape nut
I know.
stories.
I know. Or the referee stories. Got another referee wrote me like that one too. Yeah, seeing me running around the field with a double mask. Good luck.
Yeah,
sure.
please let us know where that game's going to be held. We would really all love to come out and cheer you. And that cheering,
Instagram.
that sound you hear won't be cheering. It'll be like, oh, look, he's still, oh, no, he's down. He's down. All right, everybody, good job. Thanks for the, Tom, you tried so hard. You get one of those applauds, like, when they carry you off the field on a stretcher.
Like the age isn't enough of a deficit. You got to throw the masks on there too.
855-935-TALK. Hey, Alec, you're next. Welcome to Talking Real Money.
Hi, Alec.
Hey, thanks for taking my call.
Our pleasure. What's up?
So my question is on asset allocation, how you determine your stocks to bond allocation. And so I took your risk quiz, and I got a 75. So I'm 46. I live here in Washington. I'm a firefighter, so I'll get a pension. And so I plan on retiring in about 10 years with 30 years under my belt. So just want to get your guys' advice on how to for my deferred comp or 457.
Wow, that's a great question, because this is the other part of the equation you're going to have is the fact that you have fixed income once you retire. When are you eligible to take that pension?
I could take it when I'm 53, but I won't retire probably until I'm 56, and that would put me at 30 years.
And would the pension replace most of your current income? Will
or most
it be
of your
enough
current
to pay the bills?
expenses. Yeah, will it
Pardon
pay
me,
the bills?
yes.
Yeah, so at 30 years, I'd get 60% of what I'm making now. So, and that's pretty much what I live on currently anyway. So,
wow, you're from a risk standpoint. You scored with a really high risk tolerance number.
That's a high score.
You're of a great age. You've still got plenty of time. So you got the time factor. You got the tolerance factor. You've got the lack of need factor. That's another one. you can actually be pretty blasted aggressive.
Yeah, I mean, here's the thing. Although I don't think you need returns that could burn down the house or anything either.
No,
that's the
I don't
thing.
mean crazy.
No, and that's bad. I'm sorry, bad pun. Here's a way I would look at it.
Oh, another
Thank
bad.
you. That was really.
Excuse me, was that a yellow card? Yep. That was a yellow card.
I think it's straight to red. Here's the way I would do it. I would just say, because of my risk and because of my age, I would just do a 70-30, 70% in stocks, 30% in bonds, because you can tolerate that. Because here's the other thing to really think about. And this sounds like timing to a degree, but the 10-year U.S. government bond is paying 1%. Mm-hmm. I don't want to have a lot of your money at 46 in something that's paying 1%. That's just my takeaway.
I was even leaning 80-20. Because
you could do one of the
because the diversification in equities is so great, he's still got decades, plural, to use it. I mean, 80-20 is pretty conservative, I think, given his risk quiz score and his situation. So you don't need more.
Are you okay seeing your portfolio decline by 40%
in a year?
No, I'm at 80-20 right now, and so I don't usually look at my balance except for every once in a while. So I know it's going to go down, but it's going to go back up too. So.
You got all the makings of somebody who is going to have a very comfortable retirement.
I think you're in great shape. You're asking the right questions.
Kind of decrease that asset allocation as you near retirement then?
Yes,
Maybe.
it's a glide path. You do, you start to decrease that as you get within a decade or so of needing it.
I would only, that's the critical part. That's why I was asking about the spend, because I would only start to really decrease that as I got close to drawing on that portfolio. Until then, why not make the money? Because stocks have made more than bonds. Leave it that way. Then, as I'm saying, I'm 5 years, I'm going to start pulling it out. Then I start working my way back to a 60-40 something.
And let me tell you,
moderate.
I walk the walk when I say that, because I am a lot older than you, and I'm 70-30. Because I'm
80-20.
I'm not going to retire.
Because I just want to be better than Don.
So he's more aggressive than me. But yeah, I think you're doing absolutely wonderfully. Good job. Keep up the good work.
Listening.
Keep up the job. Keep up taking care of us all, and keep listening. 855-935-TALK, our phone number.
Tom and Don are talking real money.
Our biggest event of the year, Retire Meet America 2021, is now available to everyone in the country, and it's absolutely free. Sign up now at retiremeet.com, retiremeet.com.
For your real life and real future, Tom and Don are talking real money.
Glad he did. Hey there, welcome back. We're just chatting. I'm Don, that's Tom. This is Talking Real Money. 855-935-TALK is our number. Let's go back to the very full phone lines. John, you're up. Welcome to the program.
Hi, Don.
Hello, John.
Hey.
And Tom, I've been going to your seminars for probably 10 years, and I've been listening to you on the radio since the 90s. And back then, you advised me to switch from individual stocks to index mutual funds. And that's pretty much what I've done. And then I read John Bogle's book. And the return that we had over the last probably 30 years is somewhere between 9 and 10%. Initially, we started out with 50% stock, 50% mutual fund. Stock mutual funds is 50% bond mutual funds. And as we accumulate a little bit more, we got to the point where now we're running 70-30. And the reason being is we have what we need to pass on to our children. But the main question I want to ask you today is, we're going to give several $1 million to charity, but there are three different ways that I thought of doing it. And one is Vanguard Charitable. The other one would be directly to the institution. And the third would be to contact Vanguard and set up some kind of a distribution system to the individual institutions. The problem I ran into when I checked on the individual institutions and their rate of return on their endowments is pathetic. So that's why I'm looking at other sources. What are your thoughts?
Yeah, I mean, there's other. So is some of this in a qualified type account, or is this all brokerage type money?
Post-tax or pre-tax? It's all brokerage money.
Yeah, I mean, so you could do. There's other ways where you could grant that money to be given away, but still have it properly managed. You don't necessarily have to use Schwab's management or Vanguard's management per se. That's just a titling thing. I mean, in other words, because it sounds like to me like you're ready to do that, but you don't want to give it to them to manage because their returns have been poor.
No, he was talking about giving it directly to the institutions to whom he was going to give to the charitable groups. He's saying that their investment management stinks. Is that right?
So hand it to them now, and they're not going to make as much as you would.
Hand it to
Is
them
that what
now.
You're saying?
The Schwab, but you have control over the portfolio at Schwab, if I remember correctly, in their charitable.
Yes, that's correct.
Yeah,
you could do it that way. That's
what's
what I
it
was
called?
saying.
Schwab
charitable remainder. I always forget
no, it's
the
not
title.
charitable remainder. Schwab has a really great program. I do not know. I know the Schwab one better. And it really was what I discovered was that it gave you so many wonderful options in terms of donor advised funds, the Schwab donor advised funds. Give them a call and look into that, because you could continue to manage it in the intelligent way you are managing it, and then only then when you're no longer there, that does it go off to the charities, but it gets it out of your state and it gives you some tax advantages.
Correct.
So I would look into that. Absolutely. John, thanks for the call.
Donor advised fund.
Donor advised funds. I couldn't remember the name. Joe, you're next. Welcome to the show.
Hi. I'm retired. In my just hit 71, but I've got I've kind of had some I've had some rather well, I'm not very happy with the way the market has gone lately, and I've finally, or I guess my performance in the market, but I finally decided that I would get into. I put about 60% of my assets that I have in a rollover IRA, and cash that I have in bank preferreds, and the other half just in CDs. Now, bear in mind, I'm not really all that worried about the future and future earnings because I have property.
But let me ask you a question. You said you weren't thrilled with your performance. What were you in that you weren't thrilled?
Well, I got my head handed to me playing options. How's that?
Okay, all right.
Okay.
Well, okay,
Yeah,
we got strike one. You played options. Now you've learned your lesson, correct?
Oh yeah, but
You'll never do that again.
And down the road, I'm thinking about I just don't want to put all that much risk in the market. Now, bear in mind, I have property. I'm going to get a rather large cash payment in about 30 days. Or 20
that is
days
a totally
the sale is,
that is a total. I want to leave that off to the side, because what we need to focus on is your investment portfolio, because it sounds like you don't have a clue where to put this stuff. You were playing options, which is ridiculously risky. Then you go quickly from that to preferred stocks, which we think is absolutely crazy, because preferred stocks, while they may have a decent dividend, are also almost as risky as individual stocks. They're not as safe as bonds. You've got a hodgepodge. You're just jumping around. Here's what you don't have, Joe. You do not have an investment plan. You are just investing wildly. You're creating this melange of stuff. You need to sit down with a fiduciary advisor, someone who's 100% fiduciary, who you pay for a plan. Pay $1,500 for a plan. Make sure it is not someone who sells securities, who does not get commission, who is truly fee only, and will at least just build you a plan. You need a plan to know what your risk tolerance is, what you need your money to do for you, and then you need to build a portfolio that's really well diversified.
Thank you, Joe, for the call. No, and I would add to that instead of having a series of ideas is what you have, exactly what Don said. You need, here's what I'm trying to achieve. Here's how much risk I want to take. Build the portfolio correctly from there.
Yeah, because right now you're just kind of jumping around. You're just trying to dive from one thing into the other. You're probably watching way too much CNBC or Fox Business and reading too many financial publications. You need to stop doing that and spend that money on getting a plan. And Jim, you're up. Welcome to Talking Real Money. Hey, Jim.
Jim.
Hi.
What's up?
Hey.
Hi there, guys. Hey, First, I'll just say that I really enjoy you guys.
Thank you.
And I appreciate everything you guys do. But so here's my question for you. I've been a Teamster for almost 40 years. I have a pension, and mostly I'm invested in the S&P 500. And I have a little cash on the side and another IRA, and I'd just like to know how you guys feel about that. I'm highly...
Well, I would run out and buy a different type. I'd go, if it's just the S&P 500, then go buy an international fund or a small cap fund, something so you have exposure to other stocks.
Is that S&P 500 fund in a retirement plan?
Yes, it's in an IRA.
And he said he has another small IRA. Yeah,
and then you've got cash in the other one. You just need to diversify. Either that or just go get VT, the Vanguard Total World Stock Index Fund.
VT holds 9,000 companies. The S&P 500 has 500. So we'd like to see you more diversified. Over time, that's reduced the volatility and actually increased the return a little bit. Not lately. The S&P 500 has been the better place to be. But over the long haul, you want exposure to those other stocks.
Absolutely, because in the 2000s, from 2000 to 2010, the S&P 500 was not the place to be, and those other stocks were the place to be. So you'll never be in the exact right place at the exact right time. You just want to be in all the places all the time.
Yeah, Vanguard has a very fine small cap value fund. If you had a small IRA, that would help balance out things a little bit, because now you got
but for sheer
different types of
simplicity,
stocks.
You might just want to do the whole thing in a total market fund if you're able to do that. Thanks for your call. Thank you all for calling. Remember, you can call us 24 hours a day, 7 days a week at 855-935-TALK, 855-935-8255.
Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
They called him crazy. They called him nuts. They called him insane. They said he was out of his mind when years ago, a man suggested an event that was all about retirement.
And I'm the guy who called him crazy. Yep. I'm the guy who said he was insane. I was the guy who said, do not do that. You'll take us right over the ledge.
And I said, I have the best name. I have the best name, because it was on Valentine's Day. I remember the first one was on Valentine's Day.
It was.
And I said, we'll play the Valentine's Day thing up, and we'll call it Retire Meet, as in meet the future of your dreams, like meet the mate of your dreams. And darn it, what are we now, 7 years later?
Never worked. And it worked.
7 years later?
I was wrong. Yeah, 7. This is the seventh one. Yeah, so it's all virtual this year because
takes a big man to admit you're wrong.
I know. This is the 20th, 3 weeks from today. You got to be part of it. It's virtual, all great information, tremendous speakers, retiremeet.com, retiremeet.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?